So I'm going to walk you through the data, and I'm going to focus on why I don't think we're going to crash like we did during the Great Recession. And I'm going to tell you what you should be paying attention to. There's one variable, a key variable that people need to understand to help them understand what happened, first of all, and what's likely to happen going forward. So I'm going to bring up my deck here real quickly, and we'll cover some of that. So for you guys, if anyone watched my YouTube channel, there's going to be some of information that I'm going to cover. There's some new slides that I put on here, but I think this is going to be key. And I don't know everyone on here, so I don't know if you guys know me. I'm going to give you a quick little background of who I am and why I'm qualified to talk about real estate mortgages and the stock market and really in anything. So I've been in the financial services industry going on a little over 19 years. I have the highest designations, worked on the highest teams. I've been playing at the highest level with ultra high net worth people for quite some time. And over the last couple of years with Rob, we've kind of decided to create this academy and kind of go out to people that normally we wouldn't reach because they don't meet our minimums. So here are some of my designations. You guys can look them up. They're all the top designations there. But what I'm going to do is cover this very quickly with you guys. And so what I want to do, and I know not everyone's a numbers person, but this is key. It doesn't matter if we're talking about real estate. It doesn't matter if we're talking about cars, watches, the stock market. Anything you're talking about is going to come right back down to that Econ 101 supply and demand, right? And so what I did here is I illustrated a couple of things, and I'm going to walk you through what happened. And then I'm going to tell you that, because you have to understand where we were and then what happened, what got dislocated to understand where we're likely to go, right? So here are demand curves in red, supply curves in green, and price is where supply and demand meet, right? So before COVID, we're going to look at basically D1. So before COVID, there was a demand of D1 and a supply of S1, right? So where D1 and S1 meet, we were here. So this was the quantity that was being produced, and we were at this price. So what happened with COVID is it dislocated things. COVID changed the way people looked at real estate for a couple of reasons. One, people were migrating away from the cities. No one wanted to be compact. So people wanted to go to the suburbs and buy single family residence. Also, the workforce changed. People were able to work from home. So people wanted to buy bigger homes that had that extra room to be able to work from. So what ended up happening is the demand curve shifted from D1 to D2. At the same time that supply curve switched from S1 to S2, right? So I talked about D1 to D2, there was more demand as people wanted to go to the suburbs to buy homes. That increased the demand. Supply was already somewhat tight before COVID, but it got really tight. And so inventory came down. So now what ended up happening is that here's S2 green and D2 when they meet. So we saw the quantity actually come down, right? So things got tighter than before COVID, and that increased price for two reasons, because demand increased, but supply decreased as well. So that made the prices go up. So that's what happened with COVID. Now, we're a few years now into that situation. We're kind of getting out of that. And so what's happening now? A couple of things, right? So no surprise to anyone on this call, interest rates have gone up pretty high. We were at 3% at the start of the year on a 30-year fixed rate mortgage. We're pushing 7% now. And so what's happening is demand is going to come down, right? Affordability, and we'll talk more about that in a moment, is a challenge. Now what you're going to see is the demand go from D2 to D3, right? It's not going to go back to D1. It's going to go down to D3. And supply, it's very, very tight right now. Supply is going to get a little bit better, but it's not going to get to where it was before COVID. So you're going to see the supply curve go from S2 to S3. So now what we're going to see is S3, this green line where it meets D3. So we're going to be here. So in other words, inventory is going to increase a little bit because it's so tight now. And what's going to happen is price is going to come down from where we were in COVID. We just cannot be growing at the pace that we were, growing 18, 20% year over year. To give you some perspective, going to the 60s until now on an annualized basis, homes have increased at about 5.5% annually. When you see these big increases, it doesn't take a mathematician to know it's just not sustainable. So prices are going to come down, and then inventory is going to get a little bit better, but we're not going to go back to where we were prior to COVID. On the national level, to get back to where we were prior to COVID, so January of 2020, we would have to drop about 30% on the national level from where we are now. That is highly unlikely. To give you some perspective, during the Great Recession, from peak to trough, we dropped about 27.5%. So we would have to drop even more. And I'll show you why with data. We're nowhere close to the issues we had during the Great Recession. So as you speak to clients and they get concerned, home prices are going to crash. They're not going to crash. They will correct. And I feel I'm very data driven to be very transparent and say home prices probably have gone up too much, and in some areas more than others. So we're going to see a pullback. It's just a natural ebb and flow of any market, but it's not going to crash. And I'm going to show you why here in just a moment. And then, okay, cool. So looking at the slides, right, let me go back here. So here's supply and demand. Now you might be thinking, okay, well, this is great. This is what they teach you in a textbook. So what? I'm going to show you real data, how this is playing into it, right? So we talked about demand, we talked about supply. So now let's look at information from the National Associations of Realtors. They put this out every month. It's going to be coming out, I believe, updated next week. So here's the latest info we have. So what you're seeing here are prices, right? So what you're seeing here is home sales have been coming down. They've been pretty low, but as of late, you're seeing these big decreases, right? So the last print we have, August of 2022, is down about 20%. Normally, when you see supply, if people aren't selling, right, then people are not buying. So this is the demand part of the curve. And what you're seeing here is that it's true. You're seeing here sales are going down because demand's going down because of affordability, and we'll talk about that. So when people show these charts, they normally say home prices are going to go down. That's not true. In fact, look for this period of time. As they were decreasing, home prices were actually increasing. So you're seeing these big year-over-year increases, right? You're seeing the 15% there. Now, what you're starting to notice here is a deceleration, and that's key for you to talk to your clients. The first thing you see before anything goes down, you're going to see it decelerate. That means it's going to grow at a lesser pace year over year, and that's exactly what we're seeing now, a deceleration. Right, and you're seeing here, you're seeing on a month-to-month basis, it's kind of come down a little bit. I wouldn't focus too much on the month over month as of right now, just because you guys are realtors, you know, during the spring and early summer is the hot season. You normally see it slow down, and you see this in the data. You kind of see here like a decrease too, right? Even before COVID, it's just a natural decrease. Did you guys have a question on that?
No, I think that's pretty solid. I like it so far.
Cool. And so the key here, if you want to understand what happened and what's likely to happen, you have to pay attention to inventory. That's going to be key. Understanding inventory, because the reason why prices have been going up when sales have been coming down is because inventory is so tight, right? Back to that supply and demand. This is the supply part of that curve. We're at about 3.2 monthly supply. In a normal market, you would expect about 6 months. So we're still very, very tight. And I'm going to argue we're going to remain pretty tight, right? I'll give you some perspective. During the Great Recession, we got way up to about like 10, 11 months, right? We're nowhere close to that right now. We're at 3.2 months. Another way of looking at it is looking at the absolute number of homes. So everything I'm going to start focusing on is going back to this supply curve, right? Coming back, you have to understand the supply curve. And so what I'm showing you here is that right now supply in September, we're at about 1.19 million units. So we're this yellow, we're nowhere close to where we were prior to COVID. So if you look at 2017, 18, 19, right, during this time period, we're way up here, about 1.6 million units. We have a lot less inventory. So the key is inventory. If inventory continues to go up a lot, you're going to see home prices take a big hit. And that's exactly what happened during the Great Recession. Why did inventory go why did it expand so much during the Great Recession? Well, for those of you who were in the industry at the time, you know that loans were given to pretty much anyone who said that they had income, right? So a lot of people bought homes they couldn't afford. and there were a lot of foreclosures. That sent a lot of homes for sale and increased the inventory a lot. So that's the key. What happened during the Great Recession was that inventory went up so much because there were so many homes being foreclosed, because a lot of people bought homes with nothing down. And so things went down a little bit and they were underwater, and they were basically incentivized to let their homes go. And that's a big issue of what happened. So again, total inventory, we're nowhere close, right? So keep that in mind. So when a client says, I think there might be an issue, right now, absolutely not. And in fact, so I don't know those who follow Patrick, but David, he was making this case months ago when I made a video. He was focused on somewhere here, and he was saying, hey, this curve is going to go this way. And when it goes this way, inventory is going to be increased and home prices are going to crash. Well, actually, look, they're going this way, right? They're decelerating. So the data is showing we're headed nowhere close to what we saw during the Great Recession. Now, this is inventory. So you want to start thinking ahead. Well, if I'm focused on number of homes, maybe I should start focusing on the number of homes that are actually coming to the market, right? And that's the newly listed homes. So now again, yellow is where we are today. Newly listed homes are coming at 438,000 units. Yes, it's going down, but again, like I talked about, that's just a seasonality, but it's a lot lower, right, than prior to COVID. So there are fewer homes coming into the market, because a lot of times I've talked to people, inventory is tight relative to the past, right? I've shown this chart and they say, oh yeah, that's true, but more homes are going to come into the market and the inventory is going to increase. You don't just see it, right? I'm like, okay, well, let's look at the data. These are homes that are actually coming into the market, into the inventory. It's actually decelerating more than it was before. So that argument that more homes are coming into the market is flawed, is not true. The data showing is actually lower, meaning inventory is going to remain tight. One thing I want to point you, and this is a new chart that I grabbed for the call today, is home ownership vacancy rate. It's at record lows, right? So again, this is focusing on inventory. If there are more homes available, right? If there's more vacancies, that means these homes are going to get sold. Inventory is going to increase. That's what you saw here during the Great Recession, right? You see this increase where it went up. We got to about 2.5% of total homes were vacant. Here's where we are now, right? We're like at 0.8%. We have been looking at the data back to the 60s. We haven't been this slow. So when people argue more homes are going to come into the market, the vacancy shows the opposite. There's actually fewer homes that are vacant, so less inventory down the pipeline. Here are foreclosures, right? Here's key. Here's what happened during the Great Recession. Foreclosures got up to, call it 550,000 units, homes that were foreclosed during that period here. Look where we are now, right? We're about 70,000 homes for the quarter, nowhere near here, right? So foreclosures is a telltale sign. If people are going to foreclose, those homes will make it onto the market. Inventory is going to increase. If inventory increases at a much higher rate than demand, then you're going to see home prices come down. That's what happened during the Great Recession. That is not what the data is showing. In fact, people were, and again, I don't want to pick on Patrick, but David, but a lot of people follow him. He was arguing, right, that this is going up a lot, and he was saying this is going to shoot up. What you're actually seeing is a deceleration here. The latest print that came out about a week ago shows that it's starting to stabilize lower, meaning it's not going to continue to go up a lot. And the reason why we saw an acceleration is that people couldn't be foreclosed on, right? During the the COVID situation, the government said you can't foreclose on people. And obviously that's going to keep foreclosures extremely low. That's why you see this big drop. And people were thinking now that that's gone, foreclosures are going to spike up. They've moved up, but they're starting to stabilize. So again, my argument, inventory is going to remain tight. That's the theme you're going to hear me say over and over. And here's the data supporting it. Here's another data point. This is looking at housing starts. Right now, and you guys are in the industry, right now, we have a home shortage, period. Right now, there are more people that want homes than there are available. Now, single family residents, I mean, that inventory is just, it increases or contracts depending on people who put their homes for sale. New homes, right? So home builders are the ones that put brand new inventory into it. What you see here is that they overshot during the Great Recession, right, when the party was great, and then they undershot a lot. Now they undershot so much that we're at about 1.6 million units under. It's going to take them about a decade to catch up, to get that supply and demand to meet. So again, another data point why inventory is going to remain tight is just new homes aren't being built. And if you paid attention to the new home market, builders are very pessimistic about what's likely to happen over the next 12 months. When they're pessimistic, they're not going to build. So they're going to create a bigger challenge to the home shortage already. So again, demand and supply and demand. If the supply, the inventory remains tight, prices are not likely to crash. And then here's the other piece, right? Total equity. So here's equity in a home. This is from Fred, the Federal Reserve. Here's where we are right now. There's about $30 trillion of home equity right now in the US. During the Great Recession, we were close to about 14 trillion here. Why is this important? Well, during the Great Recession, when no one had equity, people who bought homes they couldn't afford, as soon as there was no equity, they have no incentive to keep their home. They're going to let it go, let the bank take it, and then that gets put into inventory. There's so much equity here. There's a big, big cushion. No one's going to let their home go if they have equity. They're going to figure it out because then you're going to let money go. There's a big cushion here of home equity. And again, this is going to keep inventory rather tight. Now, the bigger challenge here is affordability. Right now, we're looking back at the demand. Affordability, here's what you could see. And what I'll say, you could focus on, here's the index. And you can pull this index, it's free. The higher the number, the more affordable, right? So you can see here, July of 2021, we're at 146. Now we're at 102, meaning things are a lot less affordable for two reasons. One, back then, the median home was 371,000. Now it's 410,000, right? Just homes have gone up, we know that, but also rates have gone up a lot. Back then, rates were at 2.92%. As of this was 5.48. Obviously, things have gotten worse, and we'll talk a little bit more about that. So that's made things less affordable for people. Another way to look at it, and I just created this chart for you guys, it goes to show, right? So if someone wanted to buy, let's say, an $800,000 home, when rates were at 3%, that principal and interest payment was $2,691. Now rates have gone up pretty much 7%. That same home, that payment now is $4,233. It's substantially more expensive now. You can see it at different price points for different interest rates. I'll shoot you guys over the slide so you can play with this. You could kind of see, like, look, like at 1.3 million at 3%, 4,373. At 7%, 6,879. Another way to look at it, if someone could only afford 3,500 for principal and interest on their home, right? And let's say they weren't going to put anything down. I did this just to make the example simple. When home prices were at 3%, they could afford a home that was worth 832,000. Now with rates at 7%, right? Now they can only afford 529,000. So home prices, there's a downward pressure on home prices for this. Now there's a lot of people that focus on this and they tell you this is why homes are going to crash. Remember, look at supply and demand. This is looking at the demand. This is true. There's a challenge here. And that's why I'm saying prices are going to come down. That's why I'm saying they're coming down, because of this. Now, I'm not saying they're going to crash because of the inventory, what I've been talking about. Right now, let's look at mortgage rates. This is the last survey as of 10/13. It comes out every Thursday. There it is, 6.92% on the 30-year fixed rate mortgage, right? This is Freddie Mac. It's done every week. It's the most quoted thing out there. They go out and they look at mortgage brokers and they say, what's your average for the week? And here's what it is. So here's what the media quotes. Right now, 6.92. And then here's the key. To understand that the mortgage market, you have to understand the 10-year US Treasury yield. So what I'm showing here, here's the blue. Here's a 10-year US Treasury yield in blue. And then in red is the 30-year fixed rate mortgage, right? Without giving you any data, you see that the red is above the blue. And the reason is that the blue is a risk-free rate. And I'm not going to get into all the details because that's going to require some more time. But 30-year fixed rate mortgages on average trade above the 10-year US Treasury yield at about 1.71%. That's That's kind of bad, but that's supposed to be a 1.71%, going back to the 70s. So if you want to know where mortgages are going to go, if your client asks you, where do you think mortgages are going to go? You can Google, you can go on CNBC Finance, Yahoo Finance, look for the 10-year US Treasury yield, and you can add 1.71%, and it's going to give you a general idea of rates, where rates should be. Now, right now, when things are dislocated, the spread, the difference between that red and blue line is wider than it normally has. That's a natural phenomenon in the markets. When there's a lot of uncertainty, you see a lot of volatility. We're seeing it in the stock market, plays out in the bond market, plays out in the mortgage market. And so what's happening here is I noticed that on average, when things are bad, the spread it goes from 1.71 to 2.5%. So if you want to know where 30-year fixed rate mortgage should be, find where it is now at 2.5, and it's going to give you a general idea. So and I created this model, and what I have here is I always like to show proof, because people can say, well, so what? I mean, how do I know this is true? I went back to the early 70s and I said, where were rates in 1970? If I added this 1.71, if I fast forward 12 months, where were rates versus what I forecasted? And I did that over and over and over and over and over. And then it gives me a pretty solid line here, right? And so for those of you who know statistics, you know the R square is 0.88. That's pretty solid. Does a pretty good job at predicting what it's supposed to do. Long story with 30-year fixed rate mortgage, more likely than not, in 12 months, we're going to be somewhere where we are today. There might be a little bit of downward pressure on yields because inflation, for the most part, is starting to peak. And so what's driving this whole dislocation is inflation, the Fed increasing short-term rates, putting pressure on the long-term rates of 10-year US Treasury yield, which is then translating into the mortgage market for the 30-year fixed rate mortgage. So that's what's happening there, right? So all in all, basically, here's my argument. Here's why inventory is going to remain tight. Number one, there's about, and this number is probably higher now, 70% of homeowners have mortgage rates of less than 4%, according to Zelman and Associates. Now you might be asking, well, so what? Well, remember, it's all psychology. If I own a home, right, and then you guys know this in the industry, when someone sells a home, they usually buy another home. People don't usually sell a home and then take the money somewhere else. You have to have a place to live. So you sell a home, you buy a home. If I own a home, right, let's say I bought a home for $1 million 3 years ago, and my rate was 2.75%. I'd be stupid to want to sell my $1 million home, right? Let's say it went up a little bit, right? Because then I'm going to have to buy another house, and then I'm already a little concerned that prices might come down some, and I'm going to go from a 2.78% or 2.75% 30-year fixed rate mortgage to a 7%. Right? It's just not going to make sense mathematically. So people are going to say, if I don't have to sell my home, I'm not going to sell my home. I'm just going to wait this out. And so that's going to keep inventory somewhat tight. The other thing, lending standards, we kind of talked about this during the Great Recession. Anyone can get a mortgage. Very different now, right? It's been like this for some time. You had to go through quite a bit to be able to get a mortgage because the banks, right? The banks got bailouts during the Great Recession. Part of the deal was that they had to tighten their lending standards. There were certain requirements that they had to keep that got passed all the way through every single unit of the bank, including the mortgage unit. And that's why things became more stringent. And so the average home buyer now is a lot stronger than back then. So again, less homes coming in, which kind of leads to the foreclosure, right? Foreclosure are a multi-decade lows, not likely to spike up. So keep inventory tight. Talked about home equity being at all-time highs, and then the home housing shortage, right? So all this is going to keep inventory tight. Now, your average buyer or your average seller may not understand this, but as you start moving up to the ultra high net worth clients, to Jose's questions, well, what are the ultra high net worth people doing? This is exactly what we're talking to them about, right? And to them, it makes sense. The great thing is that most of them, they don't have to sell. And a lot of times the psychology of the stock market plays into the real estate market. Right now, what's happening, for those of you who are paying attention to, the S&P 500, which is the index of the largest 500 companies in the US, is down about 23%. We're having a pretty good day today, but overall is down quite a bit. That means that, and most wealthy people have money in the stock market. So when they see their portfolio down, psychologically, they don't feel as wealthy. So now they don't want to go out and buy. They're going to wait and say, look, let me hold on a little bit. And it's all about opportunity cost, right? These people are wealthy. Should I put money in the stock market? Should I put it in real estate? Should it be residential? Should it be multi-unit? Should it be commercial, warehouse, all this stuff? They look and see which one makes better sense. So this is how they're making decisions. And all in all, the way they're looking at single family residence is that they're looking to not necessarily go out and sell. They're just not looking to buy. And a lot of people too. And here's the thing, right? Here's the data that I'm giving you for you to share with your ultra high net worth clients or just any clients in general. But I'm very transparent when I say, here's what the data shows. But when someone asks me, should I go out and buy a house or should I wait for home prices to pull back? I say, look, if it's a home that you're going to live in, that you're not going to sell in the next 5-7 years, a home that you love in the area you love, right next to schools, a homes, family, and you can afford the payment comfortably, then the time to buy is now. Here's why. Home prices may not come down. And let me tell you this, let me take you guys back to the start of COVID, right? Remember March of 2020, April 2020, when the economy got shut down, every single analyst, every single economist said home prices were going to crash. That's it. Home prices are done. No one's transacting. The economy's going to hell. What happened? The exact opposite happened. Home prices shot up, inventory got tight, and people who said, I'm just going to wait for things to crash and I'm going to pick up a home then, they didn't, right? They waited on the sidelines. So that's the key here is take action. Now, if you're an investor, it's a little different, right? So I'm just kind of giving you the high level. And so what we do is we consult with ultra high net worth people and we kind of walk them through the situation. For us to tell you what you should do, well, it depends. What are you doing already? What are you looking to do elsewhere? And what's the time frame? What's your appetite for risk? And then we can reverse engineer and draft the plan based on what they share